There are money questions that almost everyone has. Not, how do I save more? Not, should I buy stocks? Those get answered 1,000 times a day. I mean the ones you think about at 2 a.m. when the math just doesn't add up. The ones you're almost embarrassed to Google because they feel too basic, but nobody ever actually explains them. Like, why does working harder feel like it goes nowhere? Why do rich people pay less tax than you? Why does the stock market celebrate while your city is falling apart? I looked into all of it, and some of the answers genuinely surprised me. Here's the thing. These questions aren't complicated, they just haven't been explained clearly. So that's what this video is. 8 questions, real answers, no jargon. And I'll warn you now, one of these is going to change how you think about your own debt. Let's go. Why does money feel like it buys less every year or even when your salary goes up? You get a raise, you're making more than 2 years ago, and somehow, at the end of every month, you feel exactly as stretched as before. This is not in your head. Here's what's happening. Wages go up a few percent a year, but the things that people spend the most money on, rent, healthcare, childcare, education, those have been rising faster than wages for decades. Groceries going up 5%? Annoying. Rent going up 40% in 4 years? That changes everything. Your salary might technically beat inflation, but if the slice of the economy you actually live in is running hotter than the average, the headline number means nothing to you. There's a second thing too. Every time income goes up, lifestyle tends to quietly expand with it. Slightly bigger place, better car, more subscriptions. Lifestyle creep is real, and it consumes every raise before you even feel it. The money isn't disappearing, it's just moving into a bigger container every time you refill it. But here's where it gets darker. It's not just that prices are rising, it's that the system is specifically designed so that working harder won't close the gap. And that brings us to the question most people are afraid to ask out loud. Why can't you just work harder and get ahead anymore? 50 years ago, one income could support a family, pay a mortgage, and still have room for savings. Today, 2 incomes barely cover rent in a major city. That's not laziness, that's something structural. And it happened quietly. Productivity went up dramatically. Workers today produce far more per hour than workers in 1970, but wages didn't follow. The gains from higher productivity went somewhere else. Into corporate profits, into asset prices, into the hands of people who owned things rather than people who made things. And at the same time, the price of entry went up. To get a good job, you need a degree. Degrees cost 10 times what they cost a generation ago. To live near where jobs are, you need housing. Homes cost 4 times as much and adjusted for inflation. The price of admission to the middle class rose faster than the middle class could keep up. Working harder is still worth doing. But working harder inside a system where the gains keep flowing upward, that doesn't feel like progress because statistically, for most people, it isn't. That's not pessimism. That's arithmetic. Now, if you've ever wondered why none of this seems to bother the people at the top, the next answer is going to make a lot of things click. Why do rich people pay less tax as a percentage than everyone else? A teacher making $60,000 might pay 22% in federal income tax. A billionaire with a $60 million lifestyle might pay closer to 8%. Those numbers are real, and it's not corruption. It's the tax code doing exactly what it was designed to do. Here's the mechanism. Most people earn money through wages. Wages get taxed as income, the highest rate. Wealthy people often earn money through investments. When assets grow and they sell, they pay capital gains tax which is lower than income tax by law. But it goes further. The very wealthy often don't sell at all. They borrow against their assets instead. A $10 million stock portfolio can be collateral for a cash loan. That loan is not income. Loans aren't taxed. You live off borrowed money, the portfolio keeps growing, and you never trigger a taxable event. When you die, your heirs inherit at current value. The old gains effectively disappear for tax purposes. The loan gets paid off. The cycle continues. None of this is illegal. Most of it was written in intentionally piece by piece over decades. The complexity of the tax system is not an accident. Complexity is how loopholes survive. Which raises the next question. If the people at the top are doing so well, why does the economy still seem like it's constantly on the edge of collapse? You know, the answer is one of the strangest things in all of finance. Why does the stock market go up even when the economy feels terrible? 2020, a global pandemic, unemployment at historic highs, thousands of businesses gone. The market crashes in March, then spends the rest of the year climbing to record highs. People noticed. It felt obscene. Here's why it happened. The stock market is not a measure of how the economy feels right now. It's a bet on what the economy will do in the future. When investors believe things will recover, they buy. When central banks flood the system with cheap money, that money has to go somewhere. And a lot of it goes into stocks. Also, the companies in the index are not the economy. They're the largest, most globally diversified, most profitable companies in the world. Amazon had a record year in 2020. Local gyms, independent restaurants, small operators, none of them are in the index. The market went up because big companies adapted and got bigger. The rest of the economy suffered because millions of small operators couldn't. And when you hear the market is up, it means the top tier is up. Everything else is a different conversation. But what happens when even those big companies make catastrophic mistakes? What happens when the whole system nearly collapses, and who ends up paying for it? The answer to that one made me genuinely angry. Why does every financial crisis hurt regular people more than the ones who caused it? 2008. Banks made reckless bets. The bets failed. The system nearly came apart. Governments stepped in with trillions in bailout money. Unemployment doubled. Millions lost their homes. The banks were saved. The bankers largely kept their bonuses. Why? It's not just corruption, though that plays a role. It's a concept called systemic importance. When a bank is large enough that its failure would drag down thousands of other institutions, pension funds, insurance companies, businesses dependent on credit, governments face an impossible choice. Let it fail and trigger a cascade that destroys everyone's savings, or bail it out and send the message that certain institutions are too big to be held accountable. They almost always choose the bailout. The system doesn't protect the powerful because it's evil. It protects them because they have made themselves structurally necessary. And that's actually harder to fix because it's not broken by accident. It was built this way. Here's the part that's almost poetic in how unfair it is. The same force that protects the wealthy from crisis is quietly working against you every single day, even right now, even if you're doing everything right. Why does inflation hurt some people and secretly help others? Inflation gets framed as universally bad. Prices go up, money buys less, everyone suffers. That's not the full picture. Inflation is actually a transfer. It quietly moves value from some people to others without anyone signing anything. Here's who it hurts. People who hold cash. If you have $50,000 in a savings account earning 1% while inflation runs at 6%, your purchasing power is shrinking every year. People on fixed incomes, retirees on pensions that don't adjust, Workers on fixed salaries watch their real earnings erode as prices rise around them. Here's who it quietly helps. People with debt. If you owe $300,000 on a mortgage at a fixed rate and inflation runs for a decade, you're repaying that loan in dollars that are worth less than when you borrowed them. The debt shrinks in real terms. Your wages, if they keep pace, rise. The payment stays flat. Asset owners benefit too. Real estate stocks, commodities, their prices tend to rise with inflation. If you own things, inflation often increases what you hold. Inflation rewards people who borrow to buy assets. It punishes people who saved cash. Which side of that line you're on determines whether you see it as a problem or a tailwind. That leads directly to the question I get asked more than almost any other, and honestly, it's the one with the most unfair answer. Why is it so hard to save money, even when you're genuinely trying? Most financial advice treats saving as a willpower problem. Cut the subscriptions. Stop buying coffee. If you're not saving, the implication is that you lack discipline. That framing is useful for selling budgeting apps. It's not accurate. Human brains aren't wired for deferred gratification at scale. The part of your brain that processes future rewards treats them as abstract, distant, uncertain, less real than the thing right in front of you. Saving means choosing a smaller, invisible future payoff over a concrete, immediate one. That's a genuinely hard trade neurologically, not a character flaw. And the companies competing for your money understand this better than any financial advisor does. Every friction point in a purchase has been removed. Every psychological trigger, scarcity, social proof, countdown timers, has been engineered and weaponized. You're being asked to resist a system that has spent billions of dollars learning exactly how to override your self-control. The people who save consistently aren't more disciplined. They've automated the decision so it never requires discipline. Direct deposit into a separate account before the money ever touches their checking. Systems beat willpower. Every time. The problem isn't you. The environment was designed to make saving hard, and that environment also affects something even more fundamental. What you actually get paid for your work, and why it never seems to catch up. Why do prices rise instantly, but wages take forever to follow? Prices respond to supply and demand almost immediately. Demand rises, supply drops, prices adjust within days. It's mechanical. Wages don't work that way. Wages are set through negotiation between employers who want to pay less and workers who want to earn more. And in that negotiation, the leverage has shifted dramatically over 50 years. Unions have declined. Workers who ask for more risk being replaced. Automation hangs over entire industries as a permanent threat to anyone who pushes too hard. There's also something economists call wage stickiness. Employers resist raising wages even when they can't afford to, partly because once you raise someone's salary, you've set a new floor. Companies delay and wait. Meanwhile, prices don't have that friction. A landlord can raise rent at lease renewal. A grocery chain reprices shelves overnight. A utility company files for a rate increase and gets it within months. The result is a permanent gap. Prices lead, wages follow, sometimes by years. The economy is always technically recovering. But recovery tends to show up in asset prices and profit margins long before it shows up in the paychecks of the people who did the actual work. None of these questions have perfectly clean answers. That's kind of the point. The money system wasn't designed by someone with a master plan. It's a set of rules that evolved over centuries, built on compromises, power dynamics, and decisions made long before you were born. Understanding it doesn't automatically fix your situation, But not understanding it means living inside something you can't navigate. And the one pattern running through all of it, the system tends to reward people who own things over people who earn things. Assets compound, wages don't. Debt, used strategically, builds wealth. Cash, left sitting, slowly disappears. None of that means you're powerless. It means the rules are specific, and now you know what they are.